Welcome to This Explainer. You know that feeling when you check your bank app on a Friday night and literally think, wait, where did it all go? Or maybe you're watching the news and the economists sound like they're speaking a totally different language. Well, trust me, you are definitely not alone. Today, we're going to demystify the whole thing. We're diving into what finance actually means, starting from the massive global economy right down to the actual cash in your wallet. So what is finance actually about? I mean, do you ever wonder what that word really means when people just throw it around? It's completely understandable to get intimidated by, the endless ticker tapes, the obscure acronyms, and those talking heads in suits yelling about interest rates. But if we just peel back all that jargon, we find something that isn't just dry theory. It's actually incredibly practical. The truth is, it's about decisions. Finance is not just about money. At its absolute core, it's about making smart decisions with limited resources. Think of it kind of like your time or your energy. Those are limited resources, right? You literally can't be in two places at once, so you have to choose where to spend your afternoon. Well, money works the exact same way. Whether you're a single person buying groceries, a giant global corporation building a factory, or even a national government funding roads, your resources are always limited, so your choices matter immensely. Finance is fundamentally just the study of how those decisions are made and how they shape our everyday reality. Here is how we're going to break it down today. 1. What is finance? 2. The macro picture. 3. The micro decisions. 4. Mastering personal finance. 5. The 50-30-20 rule. And 6. Making money work. All right, let's jump right into section 1. What is finance? We're going to cover the absolute basics of resource management. At its foundation, the core concepts of finance are just observing how resources are managed over time. It basically boils down to 4 things: how money is earned, spent, saved, and most importantly, grown. Earning, spending, saving, those are pretty intuitive for most of us, right? We literally do them every day. But that 4th concept, growing money, that is where the real magic happens. We're going to get way deeper into that later. But to truly grasp how the whole system works together, we need to look at finance from a few distinct levels. Which brings us to section 2, the macro picture, understanding the global flow of money. Let's start huge, macroeconomics. This is the finance of entire countries and global systems, heavily controlled by governments and central banks. Macroeconomics is where governments make sweeping decisions on things like interest rates, taxation, money supply, and public spending. And these decisions, they affect millions of people all at once. Think of the macroeconomy kind of like the climate or a massive global weather system. It's this huge, overarching environment that affects absolutely everyone, whether you remember to bring an umbrella that day or not. It's all about answering one big question: how does money flow across an entire country, and how do policies shape that flow? When the economic climate changes, everyone feels the temperature shift. And there is literally no better example of this weather system than the inflation domino effect. When inflation rises, which just means the prices of everyday goods go up and your purchasing power drops, central banks step in to basically change the climate. Step 1, they hike interest rates. Now, why does that actually matter to you? Well, step 2, higher rates mean loans cost more. Suddenly, mortgages, car loans, credit card debt, it all gets a lot pricier. Because borrowing is expensive, we hit step 3, spending slows down. People skip the vacation or hold off on buying that new fridge. And finally, step 4, because people stop spending, businesses have to lower their prices to attract customers, and inflation drops. It's just a massive, interconnected chain reaction. Now let's zoom in a bit to section 3, the micro decisions, how businesses and individuals choose. Because an economy isn't just invisible policies and weather patterns, it's actual people and companies. Microeconomics is all about how individuals and firms make choices based on resources, costs, and incentives. It shifts the lens from entire countries right down to the local level. If macroeconomics is the broad climate, say a rainy season, microeconomics is you deciding whether to build a sturdy roof today or maybe pivot and start selling umbrellas. It is entirely about how you adapt to the incentives right in front of you. Take a local business, for instance, and how they do their business analysis. A coffee shop deciding whether to launch a new, super expensive espresso drink doesn't just guess. They act like microeconomists. They carefully analyze the costs of production. The beans, the milk, the cups. They look at expected demand, asking, are people actually going to pay $6 for this? They craft a pricing strategy. They analyze the competition from the cafe across the street. And they weigh the overall risk against the potential return. Make the right choice based on that data, and they grow. Miscalculate, and they take a loss. Literally every single product you buy is the result of this exact analysis. But hey, it's not just businesses. As an individual, you are constantly making your own individual micro choices every single day. Things like, do I spend this bonus or save it? Do I invest my cash or just keep it safe in the bank? Should I take out a loan for a new car or avoid the debt and keep driving my old one? These carry real behavioral and emotional weight. And here's the crazy part. Millions of these individual choices are happening at the exact same time, and collectively, those choices are what actually build the macroeconomy. The two are totally fundamentally connected. All right, moving on to the part you've probably been waiting for. Section 4, Mastering Personal Finance, Managing Your Own Life. Personal finance is exactly what it sounds like, how you manage your own money, plan your future, and build your lifestyle. Let's be totally honest here. So many people struggle with this. It is incredibly common to feel stressed about money, but usually it isn't because the concepts are just too complex. It's simply because personal finance isn't typically taught in high school. Most of us are thrown into adulthood and expected to just kind of figure it out, which is exactly why it feels so overwhelming. We've just never been taught a structured approach. Truly mastering personal finance really means taking control of 6 pillars. Think of them as your offense and defensive game plan. On offense, you've got income management, actively working to increase what you earn, and investing, so your money doesn't just sit there doing nothing. On defense, you have expense management to control those unnecessary leaks, saving for a rainy day, and risk management, which is basically having insurance to protect you from the unexpected. And guiding all of this, your financial goals. Buying a house, retiring early, whatever it is. You need both a solid offense and a tough defense to actually win the game. So how do you manage all those pillars without getting buried in spreadsheets? Let's dive into Section 5, the 50-30-20 rule, a structured framework for success. The 50-30-20 rule is seriously one of the most effective, beautifully simple frameworks out there for managing your money. It works like this. 50% of your income goes to needs. These are your absolute essentials: rent, groceries, utility bills. Then 30% goes to your wants. This is the fun stuff: concert tickets, a weekend trip, or yes, even your third iced coffee of the day. And that final 20%, that is dedicated entirely to your future, meaning your savings and investments. I really want to hone in on that last piece, because the 20% is where wealth is built. Saving is obviously crucial for emergencies and short-term goals, but that 20% slice is the true powerhouse of the whole framework. Why? Because investing is what truly grows your money over time using the absolute magic of compound interest. Think of compound interest like planting an apple tree. You plant the seed, that's your initial investment. Eventually, it grows, produces apples, but instead of just eating the apples, you plant their seeds too. Soon, you've got an entire orchard growing on its own. Investing is the engine of wealth creation because it lets your money make more money completely independent of your daily labor. Which brings us to our 6th and final section, making money work, focusing on investing and behavioral discipline. Depending on your goals, there are several different investment vehicles you can use. You could choose individual stocks, where you literally own a tiny slice of a company. But picking winners is tough, so a lot of people prefer mutual funds, where your money is grouped with others and managed by a pro. Then you've got index funds. These are wildly popular because instead of trying to beat the market, they just passively track the overall market, usually with super low fees. If you want something safer, there are bonds, which is basically you giving an IOU loan to a government or company for fixed interest. Or you might look at real estate for long-term value generation. Now listen, you absolutely do not need to jump into all of these at once. You just need to understand your own risk tolerance and consistently invest in the ones that make sense for you. Ultimately, seeing success across any of these relies completely on building some simple habits for success. And honestly, it requires a bit of a lifestyle shift. You have to spend less than you earn, which sounds so easy, but in a world of one-click shopping, it's a huge psychological hurdle. You must avoid unnecessary debt, save consistently, invest regularly no matter what the news is saying, and most importantly, educate yourself financially. Because when you strip away all the complex jargon, the colorful charts, and the dense economic theories, finance is about behavior, discipline, and long-term thinking. It isn't really just about the math. It's about your psychology. The stock market is going to have bad days, and economies will definitely have recessions. But long-term thinking is the ultimate antidote to financial panic. Once you understand how all these systems work, flowing from the massive macroeconomy through micro-business decisions right down to your personal wallet, you have to ask yourself one final kind of uncomfortable question. Are you in control of your money, or is your money controlling you? The choice of what to do next is entirely yours. Thanks for joining me for this explainer, and I really hope it gave you a powerful new perspective to take back your wallet.